The European debt crisis that began in Greece is now affecting major economies in the Eurozone such as Italy, Spain, and even France. Recently, the heads of France and Germany met to discuss a solution for the crisis, with most experts calling for the establishment of a Eurobond. However, the meeting ended with other solutions instead. The two agreed on the establishment of a committee which will serve as an economic government for the Eurozone, as well as new taxes on financial transactions. However, with Europe firmly entrenched in low growth, there are concerns that the new tax may even have an adverse impact on its economy. Meanwhile, the Eurozone recorded a GDP growth of just 0.2% in the second quarter, the lowest since the recession of 2009, once again increasing concerns for the large economy. The Eurozone is standing on shaky ground with few solutions in sight. On today's In Focus, we discuss the crisis in Europe, possible ways out, and its impact on the Korean economy.
The global economy is shaking once again, this time from the crisis in the Eurozone. The problem of sovereign debt, which began in Greece, is now threatening major economies such as Spain, Italy, and even France. The leaders of France and Germany held a summit to discuss solutions for the economic crisis, but it ended without the major decisions needed. This is fueling fears that the Eurozone could bring about another huge crisis for the global economy. Are we really out of solutions, or is there a way out? Let's join our experts as they share their insights.
Song Won-gun, Director of the Division of Finance and Fiscal Policies, Korea Economic Research Institute. Ha Chang-guk, Professor at the College of Economics and Management of the Chungnam National University.
Welcome back. Today we are going to discuss the causes of the European economic crisis and its implications in global economy as well, with two experts, Professor Ha Chang-guk and Dr. Song Won-gun. Always welcome to our program. Well, let's start our discussion. Well, we have been talking about the sovereign debt crisis in Europe for a long time, but the situations in Europe seems to getting worse day by day. What is happening right now over there?
Okay. Eurozone economy was already in turmoil because of the debt crisis in southern European nations such as Greece and Portugal. But in addition to this debt crisis, according to the data recently released, Eurozone's growth is slowed very much. The Eurozone economy grew 0.8% in the first quarter, but the growth rate of second quarter is lower to 0.3%. And industrial output in the 17 countries in Eurozone fell from May, and which is the sharpest drop since last December. So, and Eurozone's second largest economy, France, joined Italy in the no growth club in the second quarter. So, the Greek economy contracted, and Spain's economy also contracted. Even German economy is slowing right now. So the Eurozone economy is moving from slow to no growth state right now. So low growth or no growth will worsen the sovereign debt problem. That means Eurozone's debt crisis cannot be easily tapering off sooner or later.
It's quite it seems very serious, isn't it? By the way, very recently, the leaders of the two big economies in Europe, the Germany and the France, the leaders of these two countries met together to find a solution to the economic crisis facing them. What kind of things they discussed at the summit meeting?
Well, this was this meeting between Chancellor Merkel and President Sarkozy. There was a high expectation about the meeting before it took place because, as described, the economic situation is getting worse. And there's no improvement in the prospect of this debt crisis. So a lot of people are suggesting very fundamental prescription to tackle the problem, which is basically increasing the coordination among the countries that are using the euro currency At the moment, they're using same currency, and they have one monetary policy, but 17 countries each has fiscal policy of its own. So
Right.
that crisis is fiscal policy. That government borrow too much, don't have enough revenue, so then you have problem. So to address this disparity in the area of fiscal policy, and particularly the government debt, national debt issue, a lot of people are asking, saying that the fundamental solution will be when these Euro countries come together and handle this fiscal policy issue together, such as creating common bonds. So right now, German government issues its own bond when it borrows, and Greek government issues its own, and they pay very different interest rate. German government pays very low. At the moment, it's like less than 3%. Greek government right now it's more than 15%. So to reduce this disparity, basically people in market are demanding that those countries come together and handle this together, and that will have impact of lowering the borrowing cost of Greece, Italy, and other countries, and at the same time it will raise the borrowing rates of Germany, France, and so forth. That's one of the key issues.
I see.
But it's very difficult issue. People expected some progress or movement toward addressing that issue, but it didn't take place. So there was a big disappointment.
I see. So we can say that the summit meeting between the two leaders was not very successful at the moment.
Right, there is this point.
Yes, and then you mentioned very briefly about the Eurobond. Actually, Eurobond has been suggested as a way to overcome the financial crisis in Europe. But
Right.
the two leaders failed to agree on adoption of this proposal, Eurobond proposal at the summit meeting. Why? Why they did not agree on adaptation of the Eurobond proposal?
As Professor Hall already mentioned, the idea of issuing Eurobonds is not a feasible idea right now because, yes, Eurobonds might play a role like U.S. Treasury bonds for the Eurozone economy, but making the currency bloc as a whole responsible for its members' countries' debts, it's like a kind of a creation of a full physical union. So Greece and Italy, like southern states, wants to issue Eurobonds. And Italy has filed a campaign for Eurobonds to ease the financial market pressure on the zone's weaker members. And it might soften the current debt problem, but it's not sustainable because Eurobonds make nations being able to increase their spending, which will worsen the fiscal health of these nations. It includes systemic failure. Also, to introduce Eurobonds, the fiscal system of Eurozone should be totally changed. So introducing Eurobonds means that the Eurozone is physically united. So in order to introduce Eurobonds, it is politically feasible. But Eurobonds could lead to a political backlash in Northern Europe, such as Germany, because voters and taxpayers in Germany feel they are subsidizing government spending in Europe's less efficient south.
I see.
So that's why Angela Merkel is against Eurobonds, and Eurobonds was not on the table of the meeting.
I see. By the way, at the summit meeting, the leaders, both leaders agreed to take some policy measures. Could you elaborate more about the agreement made between the two leaders at the summit meeting?
Right. There was disappointment because no big steps were taken in terms of Eurobond and expanding, for example, the emergency fund to assist the crisis-stricken countries. But at the same time, they agreed to sort of have more coordination, not exactly the full physical policy union or issuance of Eurobond, but in terms of these Euro countries come together and have a discussion about physical policy decisions about government spending, tax issues, and government debt issues. So it's a sort of a, if they are successful in having discussion, and if this happens regularly, then down the road, eventually, it will lead to sort of more coordinated physical policy across 17 countries, which will have the same effect as what people are demanding and markets are demanding at the moment. But it's very sort of cautious, measured step moving toward that direction. So that on that, both leaders agreed. But at the moment, people are saying the house is on fire. We need more sort of dramatic, drastic steps to address the crisis situation. So, given that kind of demand, the agreement was a little short, I'd say.
Well, I think as we discussed so far, the European economy is in the deep, serious conditions. And at the moment, to find the solution to overcome the financial crisis in Europe, we have to think about fundamental causes. We have discussed many times about the causes of the European economic crisis, but today, at the moment, now I want to discuss one more time about the fundamental causes of the European financial crisis. What is it?
It's very hard to say that. But anyway, the direct cause of the debt crisis is the global financial crisis followed by a severe recession. In order to overcome financial crisis and recession, Eurozone governments took the measure of expansionary monetary and fiscal policies like policy options. They increased money supply to stabilize the financial markets and increased their spending to boost the fragile economy. But because of the recession, fiscal revenues reduced sharply, so budget deficit grew drastically, and the sovereign debt problem worsened. I think, but however, there is a more grave cause than financial crisis. I think that is the welfare state. Okay, we know that the worst case of that crisis is Greece. And Greece is the textbook example of the death spiral of the welfare state. Since late 1970s, Greece took the various kind of measures of welfare policies and increased the welfare expenditures, and politicians and political parties competitively proposed welfare policies. The result is that the sovereign debt is 150% of GDP, and the budget deficit is over 15% of GDP.
15%?
Yeah. In 1980, that was only 28% of GDP, and the budget deficit was less than 3% of GDP. But sovereign debt jumped to almost 100% of GDP in 1990, and once welfare spending is adapted, it is out of control because most of these entitlements become the status of social rights. So it would be a political suicide for politicians or political parties to make significant cuts when people have been accustomed to a number of rights, and aging people have been promised huge health and retirement benefits. So the welfare state is, I think, one of the greatest grave cause of the debt crisis in Europe.
I see. Well, I like the expression of the political suicide. It's a very interesting expression. Professor Herb, many people say that the outlook of the future of the European economy does not look very good, though. So we agree with that idea. But what is your the outlook on the European economy?
Well, it's it depends on how well, how soon Europe overcomes or deals with the current crisis. And also, it's not only Europe's condition that affects the prospect of European economy, but it's U.S. is another key global economy, which is not looking good at the moment. So it's this is a sort of I mean, 2008 global financial crisis is having sort of long-lasting impact. That basically created all sorts of problems both in the U.S. and Europe, and it's sort of between two continents, they are passing these balls of troubles. You know, big debt ceiling problem in the U.S. Now it's sovereign debt crisis is one thing or another. So it will European prospect would depend on how well what they do in Europe. Hopefully they do right things soon and help themselves, but the condition in the U.S. And the sort of third anchor is Asia, China, Japan, and this country. So it will depend on all the rest. But for Europe, immediately as mentioned, the German economy, which is the anchor economy for Europe, most recent data is quite soft. The second quarter was definitely weaker than earlier periods, so that contributed to this spiking of this crisis in Europe. So it's going to take time because the economic recovery, people expected that the world going on last 2009, 2010, and early this year is kind of it's drifting down. So now for this to pick up, it's going to take time, and it will this sort of uptick will begin once this extreme uncertainty and crisis and anxiety is addressed in the short term. So at least within quarter or two, it will be sort of addressing this very urgent crisis aspect here, there, and it will be at least 2-3 quarters for the economy to start to sort of pick up and sort of get back on recovery trajectory. And that will more or less apply same to the U.S. because they seem to be moving together recently. So we need to see improvement in the U.S. economy as well as Europe. And when we have sort of both economies sort of picking up a little, then that will be good news for the Asian region also.
Well, considering the fact that the European economy is one of the largest economies in the world, and the European countries are the major trading partners for Korea, certainly there will be some impact on the Korean economy as well.
Right.
Could you elaborate about that?
Well, it's Korea just established the EU-Korea FTA. So we were expecting a lot of good things and more easy access to European market. So, shall we say, the sort of the link between Korea and Europe's economies has been, closer because of the FTA establishment. But, and at the moment, Europe's economy is not doing well, so that's not good news for Korean economy. But there are sort of direct impact in terms of reduced demand for Korea's export because Europe's economy is not doing well, U.S. economy is not doing well. So there'll be, unavoidable sort of lowering of demand for Korea's export for sure. That's more sort of direct adverse impact. And in that regard, Korea is a little covered in the sense that China is a very important market for Korea's export. China, in turn, is linked to Europe and U.S., so it's all sort of connected.
Same,
but
yes.
At the same time, since China has a pretty big domestic market too, Korea's access to China, things will be the blow of Europe and U.S. will be somewhat softened by that. But possibilities the current crisis and the financial market instability and can cause instability in exchange market, foreign exchange rates. It already happened in Europe. Swiss franc was showing, appreciating a lot. So the Swiss central bank took action to reduce it. Some time back, Japanese yen was strengthening a lot, and the Japanese intervened to address that. So this type of the exchange rate instability, which was very visible in 2008 and 2009, might resurface, and that means sort of Korea's one exchange rate also will be affected. That means also the foreign capital might move out a lot, come in a lot, a lot more sort of volatility in that regard. So the development in Europe and U.S. will have sort of perhaps bigger impact through sort of financial market instability, and that I think is something that Korea needs to pay a lot of attention to.
I see. Well, that's the very important point. Actually, he Professor He even gives us the responses that the Korean government should have to take to deal with this financial crisis. But I'd like to give you a big question to Dr. Song. Even the time is very limited, so I want you to give a very concise answer to this question. Actually, what is the solution to overcome the financial crisis in Europe?
In Europe, okay. I don't think we have a clear solution for that, but we have two things to solve right now. Europe has to have two things to solve right now. First, Greece. I think Greece is like in a state of default right now. So EFSF is not a true solution to Greece because European leaders reaffirmed commitment to bailout for Greece. And it is good news to the investors and markets, I think. But
you said EFSF, right?
Yeah, EFSF.
The European Financial Stability
Facility.
Yes.
Right. But I think Greece needs kind of a debt restructuring solution. That kind of solution should be proposed, and creditors for Greece should suffer from the losses. Without this kind of solution, Greek debt problem cannot be solved. And then the second thing is the Europe has to prevent the debt crisis spread to Italy and Spain. So, European Central Bank announced plans to buy Spanish and Italian bonds. I think this program has to be continued to relieve the market and investors. But austerity measures should be adopted, taken to reduce the budget deficit for both nations. That is the only way to rebuild the investors' confidence. So, and EFSF or Eurobonds might solve the debt problem, but it's not. I think it's not easy. And then creation of fiscal union for Eurozone might be politically infeasible. So that's why I said that it's very hard to find a clear solution for European debt crisis.
So time is very limited, so I'd like to give you about 20 seconds to each one of you. What kind of responses the Korean government should take in response to the financial crisis in Europe?
I think in the short term, we have to care about financial market instability. That's government is taking actions regard to that, but we need to maintain the close surveillance. Second part, we have to take lessons from all these issues.
Lessons, yes.
Basically, at the moment, Korea is having very heated debate about welfare spending, and what's happening in Europe is it should give us a lesson in terms of how fast we increase the welfare spending in this country. And that's a very important long-term lesson that we have to take.
Okay, I agree with Professor Ho. Korea's sovereign debt is around 35% of GDP, which is very similar to the ones in Greece in 1980. So then the Korean politics right now is very similar to Greece in 1980s. So that's the lesson from the European debt crisis.
Okay, thank you very much, Professor Chang-guk and Dr. Song Won-gun. Well, today we discussed about causes of the European economic crisis and its implications on the global economy. Through discussion today, we found it out that to overcome the economic crisis in Europe, not only European countries, but also all major countries, all countries in the world should have to work together. I think there is only one solution to overcome the financial crisis in Europe. Well, this has been Shin Sang-yeol for In Focus, and see you next time.